Good morning, Mike, Managing Directors and Global Partners. Here is your news brief for Thursday, June 4th, 2015. Ever since the Federal Reserve ended QE3 last October, investors have been holding their collective breath, waiting for interest rates to rise. Now it looks as though the European Central Bank may be losing control of interest rates as bond yields in Europe have taken off on their own. Since mid-April, the yield on German bonds have shot up from 0.05% to 0.89%. This chart only shows what has happened up until May 28th, but the largest increases have occurred this week, and it's not just Germany. The yield on Spanish 10-year debt has nearly doubled since March, and it has more than doubled in Italy. And all of this is happening despite the ECB's best efforts to keep interest rates artificially low. So far, some analysts say that investors have lost more than $500 billion as bond prices plummet. We've been saying for months, if not years, that bonds are in a bubble, and it finally looks as if it may be bursting. If this is the case, expect it to spread from sovereign debt to corporate debt and then spill over into equities. To make matters worse, if Greece defaults on its debt tomorrow, the bottom could fall out on the markets and send interest rates through the roof. Greece has a €300 million payment due to the IMF tomorrow, the first of 4 payments due this month, and has said it cannot and will not make them without new bailout funds from Europe. But even if Greece doesn't default on Friday, it certainly appears we are moving into an era where the central banks of the world can no longer suppress interest rates at or below zero. Either way, this will have a huge impact on the $505 trillion in derivatives that are tied to interest rates. Meanwhile, the financial engineering that has propped up the stock market in the U.S. to record heights continues. Bond issuance in corporate America has totaled over $100 billion per month for the past 4 consecutive months, the longest such streak ever, according to Bank of America. And a lot of the borrowed funds are being used to fuel a boom in mergers and acquisitions. In May, a new one-month M&A record was set at $243 billion. The prior 2 records were $226 billion in May of 2007 and $213 billion in January of 2000, so those dates might be telling us something about where the current market is. The M&A record last month includes Charter's $90 billion acquisition of Time Warner Cable and Bright House. To finance the deal, Charter will issue $30 billion in junk-rated bonds, which will make it the second largest sale of junk debt in history, behind only TXU Energy in October of 2007. Incidentally, TXU is now in bankruptcy. And at the same time as all of this new debt is being borrowed, corporate defaults are once again on the rise. They hit 2% last month, the highest in 17 months, and they are forecast to rise to 2.5% by the end of the year. Likewise, corporate credit ratings are also in decline. In May, Standard & Poor's downgraded 41 public companies with a total debt of $71 billion versus upgrading only 18 companies with a total debt of $43 billion, creating a downgrade ratio of 2.28, which is more than double the 1.0 ratio of last year and the 0.89 ratio from 2013. Our analysis is that if the economy were really recovering, the credit downgrade ratio would be negative, meaning there would be more companies with improving credit than falling credit. And finally, President Reagan was famous for his ability to tell a joke, and one of his most famous lines was, "The scariest words in the English language are, 'I'm from the government and I'm here to help.'" However, this chart shows that he may not have been joking after all. Every sector that the government has taken an active role in, from education and healthcare to home ownership, has experienced much higher price inflation over the last 37 years than the greater economy. So the next time a Keynesian politician promises he's going to help the poor, it might behoove us to let history be our guide. And that's your news brief.